What I'm about to share with you will have a profound impact on the housing market. It's called a port mortgage, and the Federal Housing Finance Agency, they're looking at it really close because you can actually take your current mortgage, if they pass this, and make this legit, because it's already happening in Canada and the United States, where you can keep your rate and move it from your current house to your new house. I'm also going to share with you something that is already in place that people are capitalizing on, the good, the bad, and the ugly when it comes to assumable loans, which ones can be assumed, and how to assume those loans. Now, it's important to understand they have a thing called lock-in, basically where people are locked into their homes, and here's the reason why. For 13 years, they left interest rates below 5.25%. As a result, home prices went up, people bought homes. Now, 72% of the people that have a mortgage own their home have less than a 5.25% rate. So it's a hard pill to swallow when people think, well, wait a minute, I've got a 3.5, 3.25, maybe you have one of those out there, so chime in, let us know, because a lot of people do, and they're saving a lot of money because they're not paying as much on interest. They've got a comfortable payment. However, people go through divorce, there's deaths, there's move up, there's relocation, and bottom line, there's just some people like, I don't want to put a $70,000 pool in my home. I want to buy a house with a pool, maybe in a different school district. But what it boils down to is a lot of people don't want to make that move because they don't want to go from a 3.5% rate to a 6% rate. However, there's talks of this portable mortgage that can make that possible. You see, it's not just a thing where people want to move. Oftentimes people can't move, and here's the reason why. If you have a home that you bought for $300,000 and you bought it 5 years ago, chances are that home is probably $400,000 today, maybe even more. What happens is now you have $100,000 in equity, but if you want to move up to, say, a $500,000 house, right? You sell your 3, you want to move up to 5, it's worth 4, you've paid a little bit down, maybe you did 3.5%. So bottom line is you got a $295,000 balance, $290,000 balance, you're going to make $110,000, you want to roll that 110 into your $500,000 home. What a lot of people are stuck with is like, well, I can't afford that mortgage payment. I can't afford the mortgage payment on a $500,000 house. So it's not so much as people, want to move or don't want to move, it's just a lot of them can't move. But there is a tool that people can use today, and I'll touch on this and then we'll get over to the 50-year mortgage. I want to touch on that. I know I didn't mention that in the beginning of the video, but I'll talk to you about that. I also want to tell you more about this portable mortgage, so stay with me here. People have the option of selling their home as an assumable loan, and they also have the option of buying another home as a assumable loan. Now, here's what you have to understand. Every home that's an FHA loan can be assumed, right? They can be assumed, and you basically can purchase that house, but here's the caveat. Here's where you have to understand. You've got to make up the difference in the equity. So if you're buying a house, let's say you're selling your home, you sell it straight out and you make $100,000 profit on that house and you want to purchase another home. Now, if this person has an FHA loan, for example, but keep in mind, with an FHA loan, there's private mortgage insurance, okay? So that's added into that, and that private mortgage insurance never comes off. So even though that rate may be low, they're still paying private mortgage insurance. So if you were to take your $100,000 equity that you make off your house and put it down on this house, you can assume that loan. However, you may have a lower payment, but the PMI always stays on it. Now, something a lot of people aren't aware of is that Veterans Administration, the VA, when you buy a house with a VA loan, those loans are assumable. Now, what a lot of people aren't aware of, and this is really important, and if you're not writing this stuff down, grab a pen, a piece of paper, take notes, this is good stuff. Veterans loans, VA loans, can be assumed. However, a seller of a VA loan, a seller of a house with a VA loan has to understand that you don't have to be a veteran. That buyer for your house does not have to be a veteran at all. They can assume your mortgage, right? But they have to qualify. All of these have to qualify. In other words, whatever your mortgage balance is on your house, they have to qualify and they have to make up the equity. So if you owe $300 and you're selling your house for $400, they basically got to give you $100,000. But here's what's important for veterans to understand. When someone assumes your VA loan, you can no longer use your VA eligibility because it's taken up with that house. You see, the VA loan stays with the house, it doesn't go with the veteran. Now, the 50-year loan would be a good thing, and there's a couple of questions I want to answer because a lot of people ask me a lot of questions, and I always tell people, please sure to ask questions in the comments. We do our very best to get to every single question and comment. One of the things people say, well, Wayne, if I get a 50, can I refinance it? Yes, you can refinance it if you were to do a 50, if they approve a 50-year mortgage. Now, a lot of people aren't aware of the history of how mortgages started. So back in the 40s, they started a 30-year mortgage, and you can imagine what they were saying back then, because they were just 15-year mortgages, probably what a lot of people are saying now. This is crazy. Could you imagine paying 30 years? Could you imagine paying 50 years, right? But here's what you can do. You can always refinance. It can get you in the door, and it's a big tool for first-time home buyers. You have to understand, in 2024, there were just over 4 million homes that sold, right? The average first-time home buyer now is the oldest that they've ever been. They're 40 years old, right? 5 years ago, that was just about 33, 34 years old. Years before that, it was much younger. But here's what you also have to know and understand is that usually it's between 35 and 40% of all the homes sold. In a good healthy market, we typically see 5.5 to 6.5 million homes sold per year. But here's the thing. Right now, the first-time home buyer only makes up 20% of the buying market. So last year, they only made up 20%. Bottom line is, as you'll agree, I'm sure, give me a thumbs up, home prices are high and interest rates are high. Now, the good news is if you're watching this video, the interest rates are going to adjust. They're going to come down a little bit more. They've already come down, and they're going to come down a little bit more, so just hang in there. If you're thinking about getting into the process, you have to know that 31% of mortgage applications are up for the last quarter of 2025. That's because a lot of people seen the rates drop, and they're hearing that the rates are going to drop again from people like myself. So always want to make sure that if you have a 620 or higher credit score, you can get an FHA loan. You only need 3.5% down. The seller can pay your closing cost. If you're a veteran, you've served our country, Lord knows you deserve a good piece of this land, whatever it may be, a small house, condo, doesn't matter. They insure the loan. They're going to give you 100% of the loan. Seller can pay your closing cost. You need no money to buy a house. And if it's USDA, which is in every single state in the country, it just varies because those are loans on the outskirts and the suburban areas. That doesn't mean they're way out in the country. If you want to live way out in the country, you can. But you just have to know that USDA loans are not in the heart of Nashville, New Orleans, or Atlanta. You're going to have to be 30 to 45 miles or more out of those city jurisdictions. Now you're probably thinking like me, man, 50-year mortgage? No way, I don't want anything to do that. But you have to understand, if you can purchase a house and get into a house, you're gonna be paying that mortgage down and equity's gonna be going up. See, a lot of people thought 7 years ago, I'm just gonna wait and save my money. I'm gonna wait and save my money. I get it. Get 20% down or 10% down. A lot of people aren't aware you can get a conventional loan with 5% down. If you get a conventional loan with 5% down, you don't have to pay PMI once you have 20% equity. And if you put 5% down, you're already a third of the way there because basically you have invested 5% down payment, right? For the 20% that's to come. That home balance is gonna go down. Your mortgage balance is gonna go down and the equity is gonna rise. Like for example, maybe you were one of those people that bought your house. If so, chime in and let us know so we can share this information. It gives others hope. And that's very important for others to see that haven't bought a house or doesn't own a house. But listen, you just have to understand, my name is Wayne Turner. I've been in the real estate business for 30 years. I've helped thousands of people, well over 4,000 people purchase and sell their homes. And I just tell you to do you. You have to be happy. But you have to know that people bought houses 7 years ago, 5 years ago with very little down, and they've stayed in those homes. And I tell everybody, I don't care what you have to do. I don't care what you have to do. You can make excuses or you can make money. Don't get behind in your mortgage payment. Credit cards, whatever it may be, they can slap loans and liens on you, but the last thing you want to not pay is your mortgage payment. Now this portable mortgage, or what I call mobile mortgage, portable mortgage, you have to understand that that loan can stay with your new house, right? So you're shifting it from one house to another. So all of that deed title appraisal has to be done on the new house. And most importantly, you have to understand that you have to qualify. So even though you're making X number of dollars and you got credit score and all that, you have to know that whatever your balance is on your current house, you got to make sure that you can qualify for that. Now, here's one thing that you have to understand and know, that if you were to move up from your house to a more expensive home, you're going to have to take their equity and make it up. In other words, if you make $100,000 on your house that you sell and you could move that mortgage to a new house, right? That new house has to appraise, they're going to shift all that, you keep that rate. But here's what you have to know, that you're going to take that equity and put it down on the other house. You may have to add money to that. If you don't have the cash, then you're gonna have to get a second mortgage. And basically when you get a second mortgage, you're gonna have to have a higher rate. Now, what they call that is a blended rate. So you may have a 3% mortgage and carry that over to a new house. But if you're going to borrow $50, $60, $80,000, they're going to charge you a higher rate, and that may be anywhere from 6 to 6.5%. You just have to know that. All of this is speculation, and this is just what's in the mix and what they're talking, but it's really important for everybody to be educated and on the know, because it's very likely to happen. Now, where a 50-year mortgage opens up a lot of doors for first-time home buyers, the new mobile portable mortgage would absolutely get the housing market rolling and going, because last year, 2024, was one of the slowest years. 23, 24, slowest years for home sales in over 30 years. Literally, the housing crash, 2008, 2009, more homes were sold then than were last year and the year before, those past 2 years. This is what the mobile mortgage, the portable mortgage, as they call it, the port mortgage, would do. It would free up a lot of people to say, you know what, I can move now. How much will my payment be? I tell people all the time, you may have a blended payment if you had to get a second mortgage, or if you're moving down, for example. Not sure how they would work that, but they may cut you a check, because if you owe $500,000 on a house and you sell it and you downsize, a lot of people are looking at downsize. A lot of folks out there just want a smaller house or empty nesters. The bank may cut you a check back. Not too sure how that's going to work. All of this is speculation, but as I mentioned before, it's good to be in the know, because they're getting really serious about it. Now, serious or not, it really just depends on what the housing market's going to do as we roll into the next year. That basically means, are the rates going to come down? If the rates come down, then we're probably going to see a spike in home purchases. We're probably going to see a spike in people moving, because they're going to be like, well, listen, I can roll my rate, I can roll or not roll my rate, I can roll my equity. You also have to understand that the top economists are expecting a 14% increase in home sales, not prices, home sales. So in other words, they're saying that we're going to see an increase in home sales, people actually selling their houses. We're already seeing an increase in foreclosures, but you need not be alarmed, because you have to understand, for 5 years, there was a forbearance in place where banks basically couldn't foreclose on a lot of these houses. They've been kind of stockpiled, and so they're now starting to feed them out, and we've seen about a 19-20% increase in foreclosures. That doesn't mean the sky's falling, but it does mean you can purchase a nice house like this one I'm walking around. You've probably seen the lake in the background. This house is $250,000 and it's never lived in. Now, this is a house that somebody could sell their house and move up to this house and get a conventional loan. You can't do FHA or VA on this house, for example, because it's missing some appliances, it's missing some fixtures, it needs a few things. Even though it looks lived in, it looks great. They even put a Christmas wreath on the front door. The bottom line is, this is a bank-owned house that somebody could pick up for $250,000 that's never been lived in. Listen, I'm Wayne Turner. Hope you've enjoyed this video. Please comment, like, and most importantly, share it with somebody that you think would be valuable in learning this information. I'm Wayne Turner. Thank you so much for watching. Until next time, God bless.